what's up, everybody? This is Rob Swanson, and we're back with episode number 3 of The Real Freedom Show. Hey, on this episode, we are going to dive into the analysis of a passive real estate investment deal. I'm going to break down for you the different components, the things you need to be thinking about, how to analyze it, how to run the numbers. How do you know where to even start when it comes to analyzing a real estate deal? And so on this episode of The Real Freedom Show, we're going to give you that tool. And here's what I think you're going to find about this. This approach to analyzing an income-producing property can be applied no matter whether you're analyzing a residential house, a rental, an apartment building, commercial property, or other investment income streams that you might consider investing in along the way. The whole idea is if you can generate and create a framework in how you approach your investment analysis and use that framework to determine first what you want out of the investment, then you can figure out and build all of the components from there going forward that actually help you accomplish the goal, make the right investment decisions, run the math right, and get what you want out of your investment strategies. Here's the reason I think this is important. One of the greatest struggles that I see real estate investors or aspiring investors have is the paralysis of analysis, right? It's this idea that says, I got to figure out how to run the numbers and I'm just not sure how to do it. It's easier than you think because there's only a few numbers that you actually really need to know. And once you understand them and can run a basic calculator, I'm talking 6th grade math, None of this fancy scientific calculator stuff necessary. I'm talking 6th grade math calculations. You can begin analyzing any real estate deal that you do out there. Now, before we dive into that, I want to throw this back out there. And I want to introduce the Ask Rob segment of The Real Freedom Show. And if you have a question, if you have a topic idea, if you have something that you think that we should be discussing on this show, or you have a question about how do we do something around money, business, or life, I want you to either call and leave me a voicemail or send me a text message directly. And that number for the Real Freedom Show Ask Rob Q&A segment is 720-605-6265. That number again is 720-605-6265. And what you can do is you can send a text message or call that number and leave a voicemail and tell me what your questions are. Ask me a question and I'll answer it on upcoming segments of the show. You know what I also want to hear? I want to hear from you if you're enjoying the show. If you're enjoying the show, would you send a text or call and leave a voicemail and just let me know what you're liking about the show? It will help me develop content. It will help me develop direction. It will help me deliver to you the things that you want to hear most about going forward. And so questions, comments, and just tell me what you think would be absolutely fantastic. So I sat down with my daughter as she was graduating high school, as she was getting ready to go off on her own out into this big thing we call the world. And, you know, she has lived around her mom and I her entire life. Imagine that. And, you know, she's always watched and observed and listened and processed information because, you know, her entire life I've been actually she had a couple years or a year and a half where I was doing real estate part-time and I still had a job working for someone else. But most of her life, She has had an entrepreneurial, self-employed father, mother, family. We've had our own business. And so she has heard us talk about a lot of different things that many kids, I imagine, don't get to hear their parents talk about. And one of those conversational topics that we really enjoy talking about is investing and money, and how does money work, and what do you do with money, and how do you grow your money, and all of these different components she's heard us talk about for years and years and years and years. And so she gets ready to go out into the real world on her own, and she decides, hey, I better ask Dad to sit down and talk to me about, how do I invest in real estate? How do I get started? What do I do? And so we sat down, and I took a 8.5 by 11 sheet of paper, and I started to lay out a strategy. And I started to lay out a plan, and I started to say, okay, here's what real estate is as an asset, as an investment vehicle. Here's how it produces income and wealth, and here's how you analyze it. On today's show, we're going to talk about how do you analyze it, and how do you start to develop your framework. I call it the brick wall from which everything else you measure against. Okay? What's the brick wall in your investment approach that says, I want to measure everything else against it? So here's what I mean by that. In real estate, there are 3 numbers that you need to know in order to analyze any real estate investment deal. The first number is, what is the fixed up value of the property? Okay? Now, here's what I want you to understand about this. Answering the question, what is the fixed up value of the property, also known as the after repaired value, the ARV, the fixed up value of the property is important because that is the anchor from which you start to analyze your investments, and it's the anchor from which you start to analyze, what price am I willing to pay? Okay? Now, this is more important, the ARV is more important on short-term real estate investment deals. It's not as important on long-term real estate investment deals, which brings me to the second number you need to know in this equation, and that is, how much income will the property produce? Okay, if you're looking at a single family house, will it rent out for $700 a month? Will it rent out for $800 a month? Will it rent out for $1,000 a month or $12,000 a year? How much income will the property produce? So the first number, the after repaired value, the improved fixed up value of the property. The second number is how much income that property will produce on an annual basis. And third, the third number, not the second, the third number is the cost of repairs. How much is it going to cost to get the property into condition equal to the after repaired value? How much does it cost to fix it up and get it to the condition to maximize its value or maximize its income? So 3 numbers: the after repaired value, how much income it will produce, and third, the cost of repairs. How much will it cost to fix up the property? Now, these are the 3 numbers that you need to know on any real estate deal. Now, the numbers simply get bigger or smaller depending on whether you're talking about a single family house or whether you're talking about an apartment building, whether you're talking about a commercial property. But these are the basics that you always start with. Now, I want to dive into each one of them a little bit deeper and talk a little bit more, because there's some important components to each one of these as we kind of figure out then how to run the math. So on the after repaired value, it all boils down to what is your exit strategy. Meaning, when you make this investment, what are you going to do next? Are you going to buy it low, fix it up, and then immediately sell it? Is this a short-term deal? Because if it's a short-term deal, that after repaired value is what is the value of the property? What is this house worth if it's fixed up that I can price it at to sell in 30 to 60 days? What is the improved value, the fixed up value, that if I put it on the market and listed it for sale and my asking price was whatever the ARV is, that it will sell in 30 to 60 days? That's the after repaired value for a short-term real estate flip. Flip it over to the other side, and let's say that your exit strategy is you're going to buy it, fix it up, and then hold it long-term. You're going to rent it out, and you're going to hold it long-term. Well, the after repaired value of that property, of that investment strategy, is different than a short-term flip. Now you're talking about a long-term hold. And the difference comes in, it's no longer about what can I sell it for, it's about what can I get it to appraise for. Does that make sense? So if it's a short-term flip, you've got to buy it cheap, fix it up, and then sell it quickly for a profit. So the after repaired value is the price that you can sell the property for in 30 to 60 days, so a quick flip. On a buy and hold, a long-term investment deal, it's all about what can I get the property to appraise for, either on a new purchase money loan, either on a new loan when you purchase it, or on a cash out refinance. What can I get it to appraise for so that I can get as much of my capital back out or put as little capital in as possible? Assuming you want to use a leveraged strategy. See, on an income property, if you're just going to pay cash, then the after repaired value, the value is less important. The value is more important. The ARV is very important on a short-term flip. It's less important on a long-term hold. What's really important on a long-term hold is the income. Okay? The income. How much money will you get out on a monthly basis based on the price that you paid for the investment? That starts to calculate your ROI. Okay, so income is critically important. Now, on a short-term flip, income is important because what if you made a mistake? Income is your insurance policy on a short-term flip. If you're doing a short-term flip and you look at the income, you can say, well, if it doesn't sell quickly, I could rent it out as a plan B, and that's my insurance policy. And you do want to analyze what is your plan B return on investment. Can you break even or make a return if you have to drop to a plan B rental? Okay, on an income property, that's the baseline. That's the most important thing, especially if you're paying cash. If you're paying cash for the property, then the after repaired value, that appraised value, is less important. Okay, and then finally, the repair costs. Okay, if you're buying and then fixing up, those repair costs go into the numbers and into the analysis of a property. Okay, and so you need to understand how to properly adjust for the cost of repairs. So let's look at some actual math and let's talk about how we do this. Okay, the first question you have to ask yourself, and we're going to talk about passive investing on this show. How do you want your money to perform? That's the question. How do you want your money to perform? And I'm just going to pull out my phone and I'm going to use a calculator here. And I'm going to show you exactly how we do this with simple 6th grade math. Okay, and so I've got the basic simple calculator pulled up. If you're watching this on YouTube, you're going to see it. If you're listening to iTunes, follow along. Here's the question. Let's say that I've got, and I'm going to pull a deal out of our real estate business that we just did for one of our buyers. Okay, we found a deal. We do a lot of offline. We do a lot of online. We do a lot of direct to seller. We do a lot of direct to agent. We buy from a lot of other wholesalers. We have a lot of lines in the pond on a regular daily basis in order to go out and find great real estate investment deals. And here's the numbers on a deal that we just did. And the reason I'm going to share these numbers is I'm going to back you into how this whole thing works. So, first question I ask you is, how do you want your money to perform? Now, a fairly common answer that I get to that question is, Rob, I'd like it to perform as well as it can. Okay, great. What is that, right? If all you know how to do is put your money in a savings account at 0.75% interest, then 5% return on your money is pretty good. If all you know how to do is put your money into a mutual fund, distribute your risk, and get a 6% return on your money, then 9% is pretty good. If you're a private lender that is used to making asset-backed short or long-term private loans, and you're used to getting 9 or 10 or 11% on your money, then 12, 14, 16% is pretty good. If you're an active real estate investor, if you're an active investor that understands money, and you're used to getting 15, 18, 22% returns on your money, then you're chasing something higher. So it all boils down to perspective and where is your frame starting. Once you can answer the question of how do you want your money to perform as a passive investor, then you can determine what price you can pay. So here's what I'm talking about. Let's say that we've got a house that its improved fixed up value is $70,000. So we've run the math, we've analyzed it, and it's a long-term buy and hold. So we believe that there are justification in the comparables in the area that an appraiser will give the value of this house $65,000 to $70,000 after the property is fixed up, improved, and rented out. Okay, so our ARV on this buy and hold investment analysis is $65,000 to $70,000. And why am I giving a range? Here's the thing I want you to know about real estate. There's an art as much as there is a science to real estate investing. And so nobody can ever come to you and say, well, this house is worth $64,293. You cannot be that specific in the value of real estate. You have to be playing, you have to play with some subjectivity, right? There's an art to evaluating real estate. So we're going to say we've got a $65,000 to $70,000 fixed up house as an income property. And we're going to say that this property rents out for $800 a month. Okay, $800 a month. Now here's where the math comes into play. I'm going to take $800 a month, 800 times 12. So I have an annual income on this property, gross income of $9,600 a year. Okay, I buy it, I rent it out for $800 a month, and I collect $9,600 a month. Now, what are we missing out of this? We're missing our net expenses, our operating costs, okay? So in in real estate investing, these operating costs are called, they're operating costs, and it's your taxes, your insurance, your maintenance, your vacancy, and your management. So taxes, insurance, maintenance, vacancy, and management. Now, on this episode, we're going to keep the math really simple, okay? And what we're going to do is we're going to estimate that our operating costs, because we have a good operational system in place, our operating costs are 30% of the gross income. So we're going to take the $9,600 a month and we're going to multiply it by 0.7. That's going to reduce the $9,600 down by 30%. And that gives us $6,720 in annual net income. So that is our net operating income, the NOI. Okay, that's our net operating income. This is how much money is coming in annually into your hip pocket National Bank, not counting debt service. Okay, the net operating income removes debt service. It gives you the ability to analyze a real estate deal based on its income and compare apples to apples to apples, regardless of any underlying debt. Okay, so we've got $6,720 a year coming back to you. So here's the question then. How do you want your money to perform? Let's say that you want your money to perform at 8%. You look at this and say, you know what? If I can get 8% on my money and I can get a check worth 8% annualized every single month, that's a good return on my money. Because remember, this is a passive investment. You're going to put your money in and you're going to get money back. So let's take the $6,720 and divide it by 0.08. That means you would pay $84,000 for that property, that income producing property, in order to get an 8% return. Now, let's say that you say, well, I'm not really into an 8% return. I'd like to get a 9% return on my money. So you go back to your $6,720 in annual income, and you divide it by 0.09. Now you would only pay $74,000. You'd pay $74,666. Okay? So 1% difference adjusts the amount of money that you will pay for a property, your purchase price, based on the income approach, by $10,000. Now, let's say that instead of 9%, you want a 10% return on your money. You're going to go back to the same $6,720 gross annual income, and you're going to divide it by 0.10. Now you'll pay $67,200 for that same property. Here's where the analysis comes into play, okay? If you've done the analysis and you say, you know what, I think I can get an appraisal for this at between $65,000 and $70,000, that drops you right into that range where, okay, I can go in, I can get an appraisal, and I can put my 20% down if I wanted to finance it, and I'm only going to be into the deal that 20%, that whatever your down payment is, because your purchase price and that appraised value are about the same. Your 20% plus closing costs, which are customary in real estate, right? And so what happens if you say, well, I'm okay taking a lower return, and so therefore I would pay a higher price to get a deal, right? I'm okay taking, instead of 10%, I'm okay 9%. Well, you're going to pay a little bit higher purchase price up front. Your annualized income is going to be a little bit lower. And the only difference if you decide to leverage the property is you might have about $6,000 or $7,000 more invested in the deal. You might have a little bit more cash invested in the deal if you ultimately leverage and put a loan on the property, if you finance it, right? And so first is after repaired value, second is the income, and third is how much does it cost to get it fixed up. Well, what this is assuming is that you want a 10% return on your money and that the property is already fixed up. 10% return on your money and that the property is already fixed up. What happens if the property needs some repairs? Let's say that it's going to take, in order to fix this place up and get it in the condition to get the appraisal and to make it a nice, safe property for tenants and their family, that it's going to cost $18,000. So here's what we're going to do. We're going to take the $67,200 minus $18,000 that you're going to invest for the improvements, and now you'll pay $49,000. Now you'll pay $49,000 for the property. You'll put $18,000 into the repairs, so you'll be all in at your $67,000, and that will produce a 10% return on your money. So the question is always, what is the condition of the property? What's it worth? What's the income? And what is the condition? Now, as a company, my real estate investing company, Real Estate From Anywhere, we sell properties to passive landlord investors who say, I don't want to figure out how to find it. I don't want to figure out how to fix it up. I don't want to figure out how to manage it and do the maintenance and find tenants. I want you guys to handle all of that. So when we sell a property, these are the numbers that we break down for somebody, because we consider ourselves a wholesaler. So we find distressed, discounted real estate. We package that up. We put our construction crews on it. We figure out what the repair costs are going to be. And then we put an asking price on that property where an investor can then say, well, if I were to buy it for $49,000 and put $18,000 into the repairs, I'm all in at $67,000. So what is my annualized return on investment? See, that's how you as an investor can analyze real estate. And listen, it doesn't matter if it's a single family house, an apartment building, commercial real estate. The analysis of the numbers is the same. Figure out what your net operating income is. Figure out that income, the third number, or the second number. Figure out what your net operating income is given a fixed up property. And the third piece then is to figure out, how much is it going to cost me to fix it up? If you can do the math. So let's just take another scenario, and we'll just kind of wrap up our math and our training based on this. Let's just say that we have a property that's going to rent for $750 a month. I want you to follow along with the math. $750 a month times 12 months is $9,000 a year in annual income. Now, what do we have to do? That's gross income. To be legitimate investors, we have to take out our operating costs. And what are they? We have to take out taxes. You got to pay your taxes. We got to take out insurance. You got to have it insured. We got to take out our vacancy, because there will be times when a property turns over where it is vacant and you don't get the income for a month. We got to take out maintenance, because when you turn a property, you have to invest some amount of money to sprucing it back up. And then you've got to take out management. So those 5 basic numbers are the backbone of creating gross income down to your net operating income. So gross income of $9,000 a month, or $9,000 a year, minus that 30% cost. So all of those other costs, taxes, insurance, maintenance, vacancy, and management, inside of that the 30% are all of those other costs. Now, depending on how you manage your portfolio, depending on your properties, sometimes your operating costs are a little bit lower, sometimes they're a little bit higher. 30% is just here, in this case, on this rough, quick, easy math, a way to analyze a deal and say, that's going to get me in the ballpark close. See, when we put properties out, when we buy them and sell them to our investors, or when we analyze them for ourselves, we look at the actual numbers, right? We look at the actual taxes, the actual insurance costs for that house, the actual vacancy. What are our ongoing vacancy rates typically running? What have we found is a good number to pull out for maintenance? Like, so every month when you get that $750 in, what you want to do is you want to set a little bit of that money aside so that you can pay your taxes, pay your insurance, set aside for vacancy. That's going to cover whenever it goes vacant, set aside for maintenance. So now you're not coming out of pocket again. You're using the income from the property intelligently and set aside to actually just cover those ongoing operating costs, right? Real estate is like any business. There's ongoing operating costs at the property level, and then you as the passive investor get to sit back there if you pick up that fifth component and have somebody else manage and handle it for you. As long as you know how to run your numbers right, then you put yourself in a really good spot. So we're at $9,000 a month, annually right now, and we're going to multiply that times 0.7, $6,300 per year. Now, if you want a 10% return on your money, you're going to divide that annual income divided by that target return on money that you want, that 10%, let's say. So you're going to divide this by 0.1. And so you would pay $63,000 for this property that rents out for $750 a month. If you do that, assuming all of those other operating costs, your net income into your hip pocket National Bank is actually going to be 10%. Now, if you were to leverage the property, put a loan on it, go get a loan from a bank or from a private lender and leverage the property, your actual return, your leveraged return, is going to go up. Your cash flow will go down a little bit now because you've got to pay the debt service, you've got to pay the loan payment, but your actual return, the amount of capital you have invested in the deal, goes down. Your return goes up, and but your cash flow goes down a little bit. So you have to decide, do you want to leverage your portfolio and get bank loans, or do you want to pay cash for your portfolio and do it on an all-cash basis? Either way, this is the analysis that we go through. And if we're selling a property to one of our buyers through Real Estate From Anywhere, this is the math, this is the analysis that we spend a lot of time just teaching guys and gals how to run. And so if this is a fixed up property, $63,000 is the price. Now, let's say that on this example, let's say it costs $20,000 to fix it up. It's a relatively distressed property. Our team is going to put effort, energy into fixing it up. So we're going to take that $63,000 minus the cost of repairs to get a $43,000 purchase price. So that's the process. That's how you go through this and figure out, what price can I pay for a real estate deal if I want a certain return on my money over time? I hope this analysis helps you. I hope it sets a framework for how you can kind of start looking at real estate and making decisions moving forward and say, I'm going to get more and more and more comfortable figuring these things out. Now, in this episode, we didn't say, well, how do I figure out what the ARV is? We didn't say, well, how do I figure out what the income is? We didn't say, well, how do I figure out what the repair costs are? We just laid out, these are the numbers you need to know, and here's the formula based on how you want your money to perform that you can use to figure out what price you can pay for any real estate investment, long-term buy and hold deal. In the future, here on the Real Freedom Show, what we'll do is we'll break each of those numbers down, and I'll take you live on my screen, and I'll walk you through how do you analyze this stuff? How do you figure out the comps? How do you figure out the ARV? How do you figure out the income? How do you figure out the repair costs? I'll walk you through the whole thing so that you can not only take the formula, take the information that you've just used to decide how you want your money to perform, and then apply these techniques to say, here's how much I want to pay. I hope this was helpful. I want to remind you, if you have questions, 720-605-6265. That's the Q&A line. If you have a Q&A, shoot me a question. Send me a text, call it, leave a voicemail. I'll answer them on upcoming episodes. If you have a comment or just a thought about, hey, I really like this show, let me know. That's the kind of stuff that really drives me and helps me move forward. I hope this broke down the formula for figuring out what price you can pay for a piece of real estate to make it a good investment deal. This is Rob Swanson for the Real Freedom Show. See you in the next episode.